The Composite Man represents the professional money, the institutions, and the expert traders whose combined power dictates the structure and direction of the market. This entity operates with superior knowledge, capital, and planning, ensuring that the majority of retail traders are consistently on the wrong side of major moves. Wyckoff's genius lay in creating a framework that allowed the average trader to read the market from the professional's perspective, anticipating their preparation rather than reacting to their execution. By mastering these 5 rules, traders can stop being the fuel for the Composite Man's campaigns and start riding the trend he has meticulously engineered. We are now going to dissect the 5 non-negotiable principles Wyckoff used to determine market position and timing relative to the Composite Man's overarching plan. Before we dive into the deep mechanics of these professional rules, please take a brief moment to support the work we are doing here. Wyckoff's principles are complex and require detailed instruction, and your support helps us ensure this valuable knowledge reaches more people who need it. Please subscribe to the channel right now if you have not already done so, and leave a quick comment below, even just a single word, to signal to the algorithm that this content is valuable. This simple action significantly boosts the video's reach, proving that this deep dive into professional trading truly matters and is worth creating for our community. Remember that the market is a challenging battlefield, and when trading becomes difficult and your confidence starts to waver, you always have a place to return to on this channel for guidance and support. We value your engagement and commitment to serious market study as we continue our exploration of Wyckoff's foundational principles. Rule 1. The law of supply and demand, the engine of movement. The law of supply and demand is the bedrock of all Wyckoff analysis, and the first rule the Composite Man must obey regardless of his power or intent. This principle states simply that if demand exceeds the available supply, prices must rise, reflecting professional accumulation and a willingness to pay higher prices. Conversely, if supply overwhelms demand, prices must fall, indicating professional distribution or abandonment of the asset. Wyckoff used this law as the fundamental gauge of the Composite Man's current dominance and whether his campaign was progressing successfully or meeting unexpected opposition. This rule provides the immediate, real-time feedback loop necessary to interpret every single price bar and volume spike on the chart. Tracking the Composite Man's imbalance requires meticulous analysis of the relationship between price movement and the accompanying volume. When heavy volume accompanies a significant price advance, it confirms that professional buying is dominating the tape, meaning demand is far exceeding the available supply. This heavy volume acts as professional endorsement, signaling that the Composite Man is aggressively soaking up every available share because he has a much higher price target in mind. Conversely, if high volume appears during a decline and the price spread remains wide, it confirms that supply is dominant, and the Composite Man is likely selling or abandoning his support efforts. This constant comparison of effort, volume, versus result, price change, is what allows the Wyckoff analyst to determine the immediate direction of the market engine. During the markup phase, Wyckoff noted that the Composite Man often benefits from a significant lack of supply, allowing prices to advance quickly with relatively low selling pressure. When the market has been thoroughly shaken out and supply is exhausted, the Composite Man can mark up prices rapidly because there is no significant opposition to absorb his buying. This observation is crucial because it differentiates a genuine professional-led trend from a weak rally fueled by speculative public interest. A healthy markup phase, therefore, shows strong bursts of buying on volume followed by minor reactions on clearly diminishing volume, confirming the continued control by the professional operator. The law of supply and demand thus provides the context for judging the strength of any given move. Wyckoff used this rule to identify the critical turning points in the market, specifically the selling climax and the buying climax. The selling climax occurs when heavy, panicked selling volume suddenly appears, often accompanied by wide price spreads and an extreme low, signaling the final washout of public holders. At this point, the Composite Man steps in to absorb this massive supply, instantly reversing the dominant supply-demand relationship from excess supply to overwhelming demand. Similarly, the buying climax marks the exhaustion of professional demand as the Composite Man sells his accumulated shares into the final wave of public enthusiasm, reversing the dominant relationship back toward supply. These climaxes are the clearest signals that the professional operator has achieved his objective and is preparing to shift the market's direction entirely. The identification of a selling climax or buying climax is not merely about recognizing a spike in volume. It is about confirming the Composite Man's definitive intervention. During a selling climax, the high volume signifies the transfer of shares from weak hands, the public, to strong hands, the professional operator. This absorption process is the first vital step in the accumulation campaign, confirming that demand has finally overcome the supply pressure. If the volume remains high but the price fails to make a new extreme low shortly afterward, it suggests the professional buying is effectively neutralizing the supply. Conversely, a buying climax shows the Composite Man distributing his position into a market frenzy. The high volume here indicates that the public is aggressively buying, providing the liquidity needed for the professional to liquidate his holdings. Once the Composite Man has finished selling, the demand suddenly vanishes, leaving the market vulnerable to a rapid decline. Understanding Rule 1 means recognizing that these climaxes are not random events, but carefully timed operations where the professional operator strategically reverses the underlying supply/demand balance to initiate his next major campaign. Rule 2. The law of cause and effect, the planning and execution. The second foundational rule Wyckoff relied upon to track the Composite Man is the law of cause and effect, which dictates that every significant market move, the effect, must be preceded by a proportional period of preparation, the cause. The Composite Man does not initiate major trends arbitrarily. He must first spend a considerable amount of time and capital preparing his campaign, whether it involves accumulating a massive position or distributing his holdings. This preparation phase, the cause, manifests on the chart as the horizontal trading range, where the professional operator works diligently to establish his position without significantly moving the price. The subsequent trend, the effect, is the vertical movement that follows the breakout from this preparatory range. Tracking the Composite Man's preparation means recognizing the trading range as the essential stage for his strategic actions. During accumulation, the trading range is the cause where the Composite Man systematically absorbs supply, testing the market and shaking out remaining sellers. This horizontal action builds the necessary foundation of demand required to support the subsequent markup phase. The duration and intensity of this accumulation phase directly correlate to the potential magnitude of the upward trend that follows. A longer, more complex accumulation phase involving deep shakeouts and extensive testing signals a greater commitment from the Composite Man and consequently promises a more substantial effect. The effect is the subsequent trend, which translates the energy stored during the cause into vertical price movement. Once the Composite Man has successfully accumulated his desired position and confirmed the path of least resistance is upward, the markup phase begins. This phase is the realization of the cause, where the professional operator actively drives prices higher, often accelerating the move as public interest grows. Similarly, a lengthy distribution range, the cause, sets the stage for a significant markdown, the effect, as the Composite Man liquidates his position and then steps away, allowing supply to overwhelm demand. Wyckoff's methodology uniquely quantified this relationship between cause and effect through the use of point and figure charting. This quantification method allows the trader to measure the horizontal width of the trading range, the cause, to project the minimum potential vertical move, the effect, by counting the number of columns across the accumulation or distribution range and multiplying this count by the box size and reversal requirement. Wyckoff analysts could project a price target. This practice turned the seemingly chaotic market into a measurable environment, revealing the precise scale of the Composite Man's planning and commitment. The power of Rule 2 lies in its ability to manage expectations and provide objective price targets based on professional commitment. If the Composite Man spends 6 months building a large accumulation base, The trader should expect a substantial markup phase that justifies that long period of preparation and capital expenditure. Conversely, a brief, shallow range suggests a minor campaign and limits the expected vertical movement. This quantification helps traders avoid getting trapped in minor rallies or declines that lack the necessary professional foundation to sustain a long trend. The trading range itself, whether accumulation or distribution, is a period of intense, strategic maneuvering by the composite man. He must ensure he acquires or sells his desired quantity without tipping his hand too early. This involves creating complex ranges, often involving false moves and shakeouts, to keep the public confused and ensure the successful execution of the cause. The Wyckoff analyst must patiently wait for the cause to be fully established and the range boundaries to be clearly tested before anticipating the powerful effect that is sure to follow. The horizontal count derived from the point and figure chart is a direct reflection of the composite man's capital deployment and strategic intent. A wider count means more shares were absorbed or distributed, requiring a larger market movement to realize the professional's profit objectives. Therefore, the trader must constantly track the development of the cause, recalculating the potential effect as the range expands or contracts. This rule provides the necessary patience to wait for large opportunities, preventing impulsive trading based on short-term noise. Rule 3, the law of effort versus result, the confirmation of deception. The law of effort versus result is the crucial mechanism Wyckoff used to confirm whether the composite man was achieving his goals easily or was meeting significant unseen opposition. This rule asserts that changes in volume effort must align logically with corresponding changes in price result. If the effort exerted aligns with a strong result, it confirms the professional operator is in control and the path is clear. If, however, significant effort yields a poor or contradictory result, it signals divergence, indicating the composite man is either struggling against strong opposition or actively deceiving the public. Tracking the composite man's resistance is paramount when applying Rule 3. Confirmation occurs when high volume, high effort leads to a wide price spread and a strong close in the direction of the trend, strong result. For example, during a markup, a high-volume up bar that closes near its high confirms that the composite man is easily achieving his goal, as the buying effort is effortlessly driving the price higher. This alignment suggests that supply is minimal and the trend is healthy and robust, confirming the professional commitment. Divergence, on the other hand, is the primary warning sign that the composite man's campaign is facing trouble or is nearing completion. Divergence is observed when high volume, significant effort, leads to a very small price spread, or even worse, a failure to make a new high or low, poor result. This situation reveals that the composite man is actively absorbing stock offered by the public during distribution, or is meeting fierce selling pressure during accumulation efforts. The market is expending a lot of energy, but the price is barely moving, indicating a balance of power has been reached, often preceding a reversal. In the context of accumulation, divergence often appears during Phase B, where the composite man is rigorously testing the market. High volume on a downward move that fails to break below the selling climax low suggests that the professional operator is successfully absorbing the remaining supply. The effort is high because the composite man is buying heavily, but the result is poor. Price does not drop significantly, because the buying is neutralizing the selling. This absorption process, tracked through Rule 3, confirms the cause is being effectively built. Conversely, during a distribution range, divergence is seen when the composite man attempts to push the price above a resistance level, generating high volume on the effort. If this high volume results in only a narrow spread or a swift failure, such as an upthrust, it means the professional is selling heavily into the public's excitement. The composite man is deliberately using the public's demand as liquidity to offload his shares, signaling that the end of the markup phase is near. The high effort for a low reward is the market screaming that the professional is reversing his intention. Wyckoff used this law to spot lack of follow-through after major professional events. for instance following a spring, a test below support. The subsequent rally should occur on lower volume initially, confirming supply is exhausted, and then quickly accelerate with high volume, confirming commitment. If, after a spring, the subsequent rally requires extreme volume just to move a small distance, it suggests the Composite Man is still struggling against persistent supply, indicating a potential failure of the accumulation. This high effort for a low reward immediately warns the trader to remain cautious. Similarly, an upthrust after distribution, UTAD, is a classic manifestation of divergence. The Composite Man exerts high effort, high volume, to push the price above the distribution range high, trapping late buyers. However, the result is poor. The price quickly retreats back into the range, leaving the buyers trapped. This divergence confirms that the professional operator has completed his liquidation and is ready to initiate the markdown. Rule 3 is the essential filter that separates genuine strength or weakness from manipulative professional deception. The continuous monitoring of effort versus result provides the Wyckoff analyst with real-time insight into the underlying health of the market. If the trend is advancing with expanding spreads on expanding volume, the Composite Man is committed and unopposed. If, however, the volume spikes dramatically and the advance stalls, the trader knows the professional is meeting a formidable opponent, likely himself, as he liquidates his position. This constant cross-referencing ensures that the trader is never fooled by superficial price action that lacks fundamental professional support. Rule 4. The 4 stages of the market cycle: the context and timing. Richard Wyckoff recognized that the Composite Man operates within a predictable, recurring framework, dividing market history into 4 distinct stages: accumulation, markup, distribution, and markdown. This law of the market cycle provides the essential context for interpreting the other 3 laws and determining the Composite Man's current strategic intent. Without correctly identifying the market stage, the application of supply and demand, cause and effect, and effort versus result can lead to incorrect conclusions. Each stage requires a fundamentally different tracking method and trading strategy. Tracking the Composite Man's intent begins with recognizing the distinct characteristics of the accumulation phase. This is the stage where the Composite Man stealthily buys and absorbs supply at lower prices, establishing the cause for the future advance. Accumulation is characterized by trading ranges, volatility decreasing over time, and professional tests designed to exhaust the remaining supply. The Composite Man aims to keep the price depressed long enough to acquire his full position, making the range appear weak and unattractive to the public. Once accumulation is complete and the Composite Man has secured his position, the market moves into the markup phase. This is the effect, characterized by a sustained advance where the Composite Man actively drives prices higher, often seeking to attract increasing public participation. During markup, the professional operator controls the trend, ensuring that reactions are shallow and support levels hold firmly. The goal is to maximize the vertical profit derived from the previously established accumulation cause. The 3rd stage is distribution, the opposite of accumulation. Here, the Composite Man quietly sells his previously accumulated stock to the public at higher prices, establishing the new cause for the ensuing decline. Distribution is often characterized by wide, volatile trading ranges at the high end of the market, where the Composite Man uses strong rallies to offload shares into public demand. The professional aims to make the market appear strong and bullish, encouraging the public to buy just as he is selling. Finally, the market enters the markdown phase, the effect of the distribution cause. This stage is characterized by the abandonment of support and a resulting decline, often accelerating as public stops are triggered and fear takes hold. The Composite Man ensures that the markdown proceeds swiftly, capitalizing on the psychological shift from euphoria to panic. Recognizing these 4 stages allows the trader to understand the professional operator's current objective, whether he is buying, driving, selling, or abandoning. The importance of Phase B within both accumulation and distribution cannot be overstated. as this is where the Composite Man truly establishes the cause. In accumulation phase B, the market moves sideways, and the Composite Man tests the supply repeatedly, ensuring that any selling pressure is absorbed. This phase is characterized by intense professional activity, including multiple tests of the lows and highs of the range, often confusing retail traders who see only volatility without clear direction. The duration of Phase B determines the potential magnitude of the markup. Similarly, Phase B of distribution is where the Composite Man systematically sells his large position, often through complex maneuvers that include minor upthrusts and shakeouts within the range. The professional operator must ensure sufficient public demand exists to absorb his massive selling volume without causing the price to collapse prematurely. Tracking the volume and price action during Phase B reveals the true underlying intent of the Composite Man, whether he is stealthily accumulating or quietly distributing his holdings in preparation for the next major trend. Understanding the 4 stages means applying the appropriate tactical response. During accumulation, the trader should be focused on low-risk entry points after successful tests of supply. Rule 5. During markup, the focus is on riding the trend and managing trailing stops. During distribution, the trader should be exiting long positions and preparing for short entries. The market cycle provides the essential strategic map that guides the application of the other 4 rules, ensuring the trader aligns with the Composite Man's long-term plan. Rule 5. The primary testing mechanisms, confirming commitment. The 5th and final rule Wyckoff used is perhaps the most practical for timing entries: the reliance on primary testing mechanisms to confirm the Composite Man's commitment. Before the professional operator commits capital to a massive trend, the effect, he must conduct final, definitive tests to ensure that the path of least resistance is truly clear of significant opposition. These tests are manipulative price movements designed to flush out remaining weak holders or trap late entrants, confirming that the preceding cause has successfully absorbed all necessary supply or demand. Tracking the final professional action involves identifying 2 main types of tests: the test of supply and the test of demand. The test of supply is most often seen in accumulation, manifesting as a spring or a shakeout. In a spring, the Composite Man drives prices momentarily below the established support of the trading range, triggering stop-loss orders and trapping sellers who believe the downtrend is resuming. The purpose is twofold: to acquire shares from panicked sellers and to confirm that the selling pressure is exhausted. The confirmation of a successful test of supply is critical and relies heavily on Rule 3, effort versus result. A successful spring or shakeout must occur on diminishing volume, confirming that the remaining supply is minimal and easily overcome. If the price quickly snaps back into the trading range after the low-volume test, it signals the Composite Man's immediate absorption and commitment. This low volume on the test is the professional operator confirming that the market is ripe for the markup phase, as there are no significant sellers left to impede the advance. The test of demand is the corresponding mechanism used by the Composite Man in distribution, manifesting as an upthrust or an upthrust after distribution. Here, the professional drives prices momentarily above the established resistance of the trading range, trapping buyers who believe a breakout is occurring. The upthrust serves to provide the Composite Man with the final liquidity needed to offload his remaining shares, selling into the public's enthusiasm and triggering buy stops. Similar to the spring, the confirmation of a successful test of demand is tied to volume and follow-through. A successful upthrust, especially an upthrust after distribution, typically involves a spike in volume as the public rushes in, providing the necessary liquidity for the Composite Man's selling. Crucially, the price must quickly fail to hold the breakout level and retreat back into the range, confirming that the professional selling overwhelmed the demand. This failure confirms that demand is exhausted and the market is prepared for the markdown. The commitment signal from the Composite Man is proven when these critical tests occur on diminishing volume, in the case of a spring, or are followed by a swift failure, in the case of an upthrust. This demonstrates that the professional has definitively assessed the market's readiness and is prepared to commit to the trend. The trader's goal is to enter the market immediately following the successful completion of these tests, aligning their timing precisely with the Composite Man's final action. Entering before the test is complete exposes the trader to unnecessary risk. Waiting for the confirmation is essential Wyckoff discipline. For example, on secondary test ERRs of the selling climax low, secondary test in Phase B, is another form of testing. If this secondary test occurs on significantly lower volume than the initial climax, it confirms that the Composite Man successfully absorbed the initial supply and subsequent selling pressure has diminished. This repeated testing ensures the professional operator has the highest probability of success before launching the expensive and time-consuming markup campaign. Rule 5 provides the precise tactical timing required for high-probability entries. The distinction between a genuine breakout and a professional test is paramount for survival in the market. A genuine breakout, confirming the transition from cause to effect, will see increasing volume supporting the move and sustained price action outside the range boundaries. A test, however, is a momentary penetration followed by an immediate reversal or lack of follow-through, confirming the professional manipulation. By focusing on Rule 5, Wyckoff trained his students to differentiate between the Composite Man's preparatory manipulation and his final, irreversible commitment. Richard Wyckoff's power lay not in applying these 5 rules in isolation, but in their simultaneous and integrated application, creating a comprehensive framework for market interpretation. The successful Wyckoff analyst must constantly cross-reference these principles to achieve the necessary confidence for action. For instance, a trader might use Rule 4 to identify the market is in accumulation, context. Then use Rule 2 to measure the width of the range and project the minimum potential markup, preparation. Crucially, the trader would then use Rule 3 to confirm that the Composite Man is successfully absorbing supply during Phase B, confirmation of deception, looking for high effort, volume, but poor downward result, small spread. Finally, the trader would wait for Rule 5 to provide the precise entry signal, a low-volume spring followed by a swift rally, confirming the professional's final commitment and the exhaustion of supply. This integrated approach minimizes risk by ensuring that every trade aligns with the Composite Man's long-term strategic plan. The ultimate goal of tracking the Composite Man through these rules is to allow the trader to trade with the professionals, moving away from the reactive, emotional trading typical of the public. By understanding when the Composite Man is in the preparatory phase, accumulation/distribution, the trader avoids premature entries and unnecessary risk exposure in sideways markets. The patience derived from tracking the cause ensures that the trader is positioned before the powerful effect begins. When the market enters the trend, markup/markdown, the trader uses Rule 1, supply and demand, and Rule 3, effort versus result, to continuously monitor the health of the move. If demand begins to wane despite high volume, or if the price fails to respond to professional effort, the trader knows the Composite Man is likely preparing for the next phase reversal. Wyckoff's rules provide a disciplined, objective method for navigating the market, replacing speculation with evidence-based decision-making derived directly from professional activity. The final instructional takeaway is that reading the market is fundamentally reading the Composite Man's preparation, manipulation, and final commitment. Price and volume are merely the visible footprints of this professional entity. By diligently applying the law of supply and demand, the law of cause and effect, the law of effort versus result, the 4 stages of the market cycle, and the primary testing mechanisms, the trader gains an unparalleled advantage. This methodology transforms the chart from a confusing array of price bars into a clear, strategic map of professional intent, allowing the disciplined trader to profit alongside the market's true masters. If the deep instruction provided by these 5 rules has resonated with your trading philosophy, and if you are committed to mastering the foundational principles of professional market analysis, there is one resource that is essential for your library. Richard Wyckoff's original teachings are the bedrock of this entire approach, yet they can often feel dense or inaccessible to the modern reader seeking immediate, actionable insight. We highly recommend exploring the adapted edition of his classic work, How I Trade and Invest in Stocks and Bonds. This specialized book provides Wyckoff's time-tested methods in a format specifically designed for today's market structure, deeply revealing his strategies for analyzing the market, determining the intentions of the large players, the composite man, and making informed, robust trading decisions. This is not just historical theory. It is a practical guide to the techniques that have defined professional trading for generations, offering the comprehensive study required to move beyond basic concepts and achieve true mastery. If you are serious about adopting the professional mindset and executing trades based on Wyckoff's proven framework, secure your copy of How I Trade and Invest in Stocks and Bonds today, available via the link provided in the description below.